We use the word disinflation, but not to be conflated with deflation. So things aren't rising as quickly as they were, but they're still going up. So I think for those consumer firms, it's a case of trying to be competitive, not trying to keep your prices flat. If others are decreasing their prices, you want to stay ahead of that. But at the same time, you can't afford to decrease your prices too quickly because you're still experiencing those cost increases. So I think it's a real balancing act for companies at the moment, and they really just have to kind of keep an eye on the competition and weigh up exactly what they can do at the moment and exactly what they can do without actually losing market share. That's the real key.
What is your expectation for consumer-facing sectors into the end of the year? We had the UK wage data come out this morning, still very hot if you look at wage growth numbers, but there are some signs that the labor market is beginning to slow down somewhat. What is your expectation for how consumer spending is going to hold up in the last quarter of the year?
So I wrote an article about this just last week. So I think it's probably the most pertinent topic in the markets at the moment. Consumer spending is the most volatile component of GDP and the one that everyone's watching. And we spoke just a couple of minutes ago about how consumers had been feeling this pain, that they're being stretched constantly. Prices have been going up. Wages haven't really kept up with that. And I think what you're seeing now in the US and indeed Europe at the moment is a slowdown in consumer spending on big ticket items and things like this. And I think that's eventually going to feed down through. So I think most consumer firms are still going to feel some pain toward the end of this year. The question is, how quickly can that turn if interest rates indeed decrease? And how quickly can they kind of recover into next year from that? And that's really, really crucial for these firms.
Michael, let me come back to luxury because you mentioned it as being in the sweet spot when it comes to the trade-off between prices and volume. Looking at the share prices of some of the big luxury names, LVMH up 6% year to date, Kering down nearly 4%, Richemont down 8%. They're actually not performing super well, certainly relative to the U.S. market as a whole, with the S&P up 17% year to date. Is there an opportunity in these luxury names, or is perhaps the China story and the weakening there enough to keep these valuations suppressed?
It's a very good point. And I think year-to-date performance, as you're right, it's very mixed among the luxury goods firms, and that depends on their exposure, whether it's been more geared toward the US or China. But also, it's worth not forgetting that they had a really good 2022. So they had a lot of share price appreciation over that period as well. So perhaps some of them are giving back a little from here. So I think you're right as well in saying that there are some opportunities opening up in the luxury space, which is a positive to see for investors. But there are some challenges ahead, like you mentioned, too. If there's a China slowdown, as we're seeing right now, and if the US consumer particularly pulls back, you're going to see some weakening there. So it's really a test of which firms are very, very strong within that space and are going to be able to maintain it, and which are the weaker ones and are going to feel that a bit harder, I think.
Michael, one other sector that we've been watching very closely in Europe is the travel sector. With this revenge travel, revenge spending, so many people have been flying back, taking trips that they weren't able to take during the course of the pandemic. And yet, if you look at the stock prices of where many of these airlines are trading, very few of them are back to pre-pandemic levels. What is needed to get them there?
So I think the travel sector, one we've commented on quite a lot lately. I think the real beneficiaries of that have been the hotel firms, if you like, the Accors, the Premier Inns in the UK, for example. So these have been the kind of front runners. I think the problem with the airlines to a large degree is they got so beaten up after the pandemic that they're only just now starting to recover. And there's still some doubt in investors' minds, and this comes to your question of what it's going to need. And I think investors need to feel that this pickup is going to be sustained and volumes are going to be sustained into next year. So I think it's time. If these airlines still have a good winter, they see good bookings coming through for winter holidays, trips, and then into next summer again, you should probably see valuations start to recover, but slowly.